This is my personal buying indicator, regardless about how you personally feel of the market conditions we're in through the last 100+ years of the S&P 500's history. Anytime we've hit periods of extreme fear has always been the most opportune time to buy stocks. Now, personally, I've added one new dividend stock to my overall portfolio I want to discuss in this video. While we broad view my TFSA, my RRSP, we'll take a look at all my accounts combined in that spreadsheet, while we also update you on recent earnings from JPMorgan, talk about the news and my expectations moving forward. So if you are on a path to financial independence, if you damn well one day will want to retire early, join that journey with me by hitting that subscribe button, folks, because in my TFSA, Google, Take-Two, VOO, I am feeling the same pain you are. I mean, it's crazy to think that I was up like 13-14% on VOO and now it's flat, and arguably my most speculative stock in my TFSA, being Take-Two Interactive, has been holding up the best. I could honestly sell it as a hedge right now and then double dip down in VOO, but I still think there's too much potential for Take-Two. We'll talk about it in a moment. On VDY, the Canadian side of my TFSA, this thing was up 10% at one point and now I'm down 2.8%. It just shows you that the last year of investing has been completely wiped out. Now, I don't have the April updates for the performance of this account, but I do have the March performance right when the market started to dip off. And as of the end of March, I was up 221% versus the S&P 500 that was up 132%. And it is important to point out that during this flatline period, I completely liquidated my TFSA to buy a piece of real estate. So currently, I missed out on some extra bumps in the S&P, but it was the condition, which is why when I show you the positions today, that all the gains have been wiped out, because I've really only been buying since basically just before 2024. So it's no surprise that a lot of gains have backpedaled, but keep in mind there's some dividends that have been in here. I traded Tesla for a 40% gain. So I'm really curious to see how far I'm actually down versus the S&P 500, also considering how much Take-Two has been holding up. I'm still speculating that I am outperforming the S&P because, again, VDY isn't down as much either. So it will be neat to see what this looks like when we get the April updates at the end of the month. Now, in my RSP, disappointingly, SCHD is not held up as well as I'd like it to. Obviously, it's not down as much, but I've wiped out all the gains, and I've been sitting in SCHD now for years in this account. Take-Two is a recent add, and I plan, again, with my Take-Two Interactive shares, selling them at some point, depending on because this is a gaming company that owns Rockstar, and I'm speculating that, Grand Theft Auto 6 is going to be the greatest piece of media to ever be produced and sold, and it's going to lead to some further hype in the company's value, and at some point in the next year or two, I will sell it to re-add it to probably in this account, maybe XEQT. I'll decide when I get to that point, but that's the overarching plan with that. But even considering I just recently bought XEQT, which is crazy for a global market ETF to drop 9% as quick as it did, I can tell you I'm not the best at timing these markets. All right, you can clearly see that in these accounts. If we look at the performance of this account, this is my best performing account because in 2019 I was buying Tesla. It propelled this account to a 317% gain where it basically sits today, but I did sell it at Tesla back in 2020, at which I transitioned that into a lot of dividend stocks and SCHD. But if you watch SCHD's history, it really hasn't done much since 2021, which is where I basically bought it, with the exception of the dividends. And only recently this account started to rally again as SCHD took off. I'm still happy with where this account sits. It's up in an insane level. The S&P is only up 88% in the same time period. Again, I'm not looking to get excelled growth, but hopefully buying, Take-Two will offer some extended gains here if that speculation works out to my favor. In fact, the only place I have any green is in my corporate account, because I opened this corporate account years ago, at which I put all the money that I didn't pull into my personal name that is less taxed in this account into VOO back then. And I mean, it's still up 20%. These are the only gains that are keeping any amount of gains in my totality in the total portfolios combined here up 3.38%. And that was as of yesterday's close. So we wiped out a huge amount of gains because we were at like 380 yesterday. And now we've wound back quite a bit. But what is the new stock that I added, guys? As mentioned, it is Meta. I'm going to talk about why I've added Meta, but you can kind of see the positioning as it sits in this moment. VDY, SCHD, VOO, XEQT being pretty small, with my speculation with Aduro, some of the small cap plays that I'm holding in my corporate account, with Google and Take-Two being some of the biggest positions. But why Meta. Why did I add Meta stock? And yes, it's a dividend stock. I know it doesn't pay a huge yield, but I still consider it somewhat of a dividend stock. But as many of you are aware, I take into consideration what my wife has in her accounts, and Meta is her single largest position. It's why I haven't bought it. It's one of my favorite stocks, but I don't want to over leverage the risk between our accounts as we try and diversify our risk between, both of us, right? But Meta recently has completely collapsed, right? I mean, the stock has dropped like 20 to 30%. It's wiped out a huge percentage of its market cap. And considering that over time, over the last year, how much we've scaled Google, Take-Two, Meta's actually pulled back to being one of the smaller individual positions. And to diversify the risk a bit more, because the wife also has been buying Google, I thought, hey, now's probably a good time to pick up some Meta shares to build it up to the level of Take-Two and Google. I mean, between these three stocks that make up pretty much six figures between our combined accounts, they have huge, growth potential into our future. But I think people underappreciate Meta and Google tremendously. If you compare the growth stocks that exist out there, you're talking about Meta trading at a 22 PE, right? If you look at their earnings per share, they were growing it at 50% the last quarter. Look at the earnings growth, the trajectory that this company has been on, and even through crazy economic events, the revenue has been incredibly stable. Yes, there could be a freeze up of advertising spend, but through, quite a few scenarios, revenue spend still tends to remain quite consistent here, and they're growing revenue at a 20% clip. And I want you to keep in mind, these companies have the most resilient balance sheets. I mean, Meta's sitting on 276 billion in total assets as of basically the end of 2024, and only 93 billion in total liabilities, 100 billion in current assets, right? This is a company that has Facebook, Instagram, WhatsApp. They haven't even monetized WhatsApp. I feel like you're paying a very fair value for the current company's fundamentals. And the cherry on top of the cake is AI. The cherry on top of the cake is VR. All this stuff that is already priced into companies like Tesla, and you get it for free with these companies. I mean, look at Google. Google's a conglomerate here with a 20 PE right now. You know what insane that is? A 20 PE for a company that's growing earnings per share by 30%. Revenue has been incredibly consistent, going up, what are we at? Last quarter was 11%. The reason I think these companies, I don't know why they're underappreciated as much. I mean, Google, you have to keep in mind, is sitting on the second amount of cash to Berkshire Hathaway outside of any other company in the S&P or the index. I mean, 450 billion in total assets against total liabilities of 125 billion, current assets 163 billion. These companies are the future, in my opinion. I don't think they've reached total parity. I don't think they've been fully saturated, is what I'm trying to say, with all businesses yet. In my business, what I do for work outside of this YouTube channel is kind of help companies get attention. We help build their channels. We do all kinds of stuff related to social media. And when I see all these old companies, or not old companies, but people that are a bit older that don't understand this stuff, that are still trying to get involved with it, I still think there's so much room for growth in totality. Especially considering YouTube doesn't pay for any, content, and it's like the most premium streaming service. It's crazy to me when you look at these businesses and how they operate compared to any other businesses out there. Like, how do you not want to own these, in my opinion, especially when it comes to Google self-driving? They have genomics. I mean, between Meta and Google, the upside is completely free at this point, in my opinion, if those features work out. And if they don't, I don't think it's going to deteriorate the stock value by any metric like it could for Tesla or some of these other stocks. But again, I think social media continues to be the future. I don't think people appreciate them enough, and I'm very comfortable making them the two single largest stock positions next to Take-Two Interactive, right? And for Take-Two, this is a short-term play. Google, Meta, presuming the fundamentals don't deteriorate in a major way, Take-Two Interactive is a short-term play outside of those, right? Like, I'm only going to plan on holding this for about 1 to 2 years max, because I think people are not appreciating that GTA 6 is the most valued piece of media ever created. Take-Two, the parent company to Rockstar, GTA 6 is going to be launching sometime this fall, and I think when people realize that it's going to sell probably 50 million copies or something, it's going to massively bolster their underlying business. It's going to make them profitable. It's going to send them into a new trajectory, because this is a company that only recently just hit highs that it hasn't seen since 2021. It's not a cheap company with the current fundamentals, but the reason I think it's been holding up so well is people understand the value of that piece of media. It is the greatest piece of media ever produced. And the last time it came out was back in 2013, and the trajectory when that game released and what it put the stock toward. And I think it's going to happen quicker. In 2013, it took a long time for the stock to realize the value of those games and everything that was going on. But this time around, I think the stock is going to easily run up to a $300-400 value within a year or two. Now, I could be wrong. It is a speculation, but I do plan on selling it and then redistributing the gains between my indexes and some perhaps other stocks. I don't really know yet because that's still quite out into the future, but it's one that I really have a deep passion for because I still love video games. That's why I also love Meta, because I play VR religiously. I'm on YouTube religiously. I like these companies where I actually use their products and I understand it better. But looking forward, I think earnings are going to be pivotal here for all these companies as they start revising guidance. And that's what we're starting to see to some extent. It is nice seeing that JPMorgan's stock actually went up. It means that earnings can actually revitalize the current market conditions, even on the back of maybe more speculative guidance. It's telling us that a lot of this fear has been priced in to some extent. That's not a guarantee, but that's how I'm starting to get a sense of the market. Considering JP, I was shocked to see that their loan loss provisions went up to $3.3 billion, up from $2.6 billion just last quarter, and up from $1.8 billion just in Q1 of 2024. These increases in loan losses are horrifying. It's something the banks are still experiencing, and I don't think that gets resolved until interest rates continue to go lower because loan losses are money these banks have to put aside as loan quality goes down. And the only reason loan quality goes down is because these people that took out loans against the cash they currently were generating, the cash they're generating is costing a lot more on interest rates, which means the quality of the loan goes down, which means the bank has to put more money aside in case they default. But I mean, still, on the back of all that, JP Morgan's revenue is sitting at $45 billion from $42 just this time last quarter. And a lot of that probably has to do with higher interest rates. They're definitely able to bank crazy amounts of money right now in the higher interest rate environment. So you have to be a bit careful as interest rates get cut, what that could do for some of the growth that these banks are experiencing. Net income at $14.6 billion is still very, very healthy. So they are able to operate on the back of higher loan losses. This isn't true for all banks, but we can see the ones that are a bit more resilient, and it'll be neat to see what the Canadian ones look like with Royal Bank and stuff. But these are markets where I think dividend investors are being rewarded. Not only do they have less volatility, but on the back of what JP Morgan said here, which I'll point out some of the fearful comments. I don't like listening to Jamie Dimon that much. I don't like listening to Ray Dalio or these billionaires because they really like talking recession fears. It gives them attention. It's what everyone kind of clicks to. It's what I've been pointing out in these videos. But basically, Dimon said that the economy is facing considerable turbulence, including geopolitics, with the potential positives of tax reform and deregulation and the potential negatives of tariffs and trade wars. Ongoing sticky inflation, high fiscal deficits, and still rather high asset prices and volatility. As always, we hope for the best, but prepare for the firm for a wide range of scenarios. However, they did increase the dividend, guys, by 12%, which is quite astonishing. They're doing $7 billion of share rebuybacks. Great time to be buying shares back and increasing the dividends. Investors are being rewarded here, and we saw the same with Procter & Gamble. They haven't posted earnings yet, but these dividend stocks that tend to be a bit less volatile here. When you look at this, it's kind of been stuck in a range for the last year. The yield's been quite sustainable, and Procter & Gamble just announced that they're basically increasing it by, I think, 5%. So across the board, this is why you want to focus on dividends. I think for the most part, I think a lot of people out there would rather focus on dividends right now because the stocks are down a bit. You're getting higher yields. You're getting increased yields. It's a constant reminder that at least you're getting paid and you don't have to worry about stock equity as much. This is how I figure retirees would like to think. And it's why I try and, depict a lot of different ways to invest on this channel. But as somebody that is only 32 years old, and though I keep spouting I want to be able to retire or at least be financially free by somewhere between 35 and 40, that doesn't mean I'm going to quit working. It doesn't mean I'm going to quit working on cash flow. And even still, between the wife and I, if our accounts went up, even 6-7% a year, that would be enough to cover the cost of our current expenditures and our way of living, because we live modestly. Even with the income we have, the portfolio size we have, I'm not buying lavish pieces of real estate. I'm not buying brand new cars. I live very modestly so I can enjoy the comforts of the financial freedom these portfolios offer. And that's why in moments like this, I have the liquidity to take full advantage of this market environment, because I'm telling you, when the sky is falling, and I've heard this multiple times now, and it's crazy to think that the S&P has gone through now its third correctional period, its third period of fear in the last 5 years. This is something newer investors, I think it's going to be healthy for them to learn this a lot more aggressively, because yeah, it's just nuts. It's just nuts. Typically, these only happen once every 7 to 10 years. We've had the pandemic, we've had the 2022 interest rate cycle. I still think a lot of the effects of 2022 were caused by the pandemic, so you could say it's kind of the effects of the same crash. But now we're in the third one, which is the tariff war, right? And it's a healthy learning environment, and it's always a constant reminder that 5-10 years from now, it's just going to be noise. I don't hear anybody talking about the effects that 9/11 had, or the dot-com bubble had, or the 2008 financial crisis had. Nobody is talking about the effects those had on the market today, and the market is materially higher. So like I said, I don't know if stocks go lower. I don't know if they recover from here. What I do know with certainty is that people are freaking out, and I get phone calls when people are freaking out from my family, my friends, asking me what's going on, and they never call me when times are good. So that's how I know it's time to buy stocks, folks, and it's time to buy them more aggressively than I have in the past. So if you enjoy these videos, let me know what you think in that comment section below.